Welcome, savvy investors and financial enthusiasts, to a discussion on the biggest investing mistakes to avoid in 2024. Now, we all know that investing can be a thrilling ride, filled with highs, lows, and everything in between. But like any roller coaster, it's not without its risks. One tiny misstep can turn your financial joyride into a nightmare. That's why it's crucial to be aware of and avoid common investing mistakes. Today, we'll be diving into 5 of the most common pitfalls that could trip you up in the coming year. We'll discuss how ignoring inflation could eat into your returns, why chasing returns is a risky game, the importance of diversifying your portfolio, why neglecting research could be your downfall, and how emotional investing can cloud your judgment. So, buckle up as we navigate the pitfalls of investing in 2024. Hello, viewers. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First on our list is ignoring inflation. Inflation, in the simplest terms, is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Think of it as a silent thief, sneaking into your savings account and snatching away bits of your purchasing power. It's a common economic phenomenon, and it's happening all the time, whether you notice it or not. Let's put this into perspective. If you have $100 today, and the inflation rate is 2% next year, you'll still have $100. But here's the catch. That $100 won't buy you as much as it could today. The cost of goods and services will have increased by 2%, meaning your $100 is effectively worth less. So what does this have to do with investing? Well, quite a lot, actually. If you're stashing your money under the mattress or in a low-interest savings account, you're not just standing still, you're going backward. Inflation is eroding the value of your money, leaving you with less purchasing power in the future. When it comes to investing, ignoring inflation can be a costly mistake. It's not enough to just make a return on your investment. You need to make a return that outpaces inflation. If your investments aren't growing at a rate that beats inflation, you're effectively losing money. For instance, if your investment yields a return of 3%, but inflation is running at 2%, your real rate of return is just 1%. That's the return you're actually getting after accounting for inflation. The impact of inflation on your investments can be subtle, but over time, it can significantly erode your wealth. It's like a slow leak in a tire. It might not cause a problem right away, but eventually it's going to leave you stranded. Therefore, always take inflation into account when planning your investments. You need to choose investment vehicles that have the potential to outpace inflation, ensuring your money grows in real terms and preserves your purchasing power for the future. Chasing returns is another common investing mistake to avoid. Now, what does this mean? Picturing it, it's as if you're running after a train that's already left the station. You see, chasing returns refers to the act of investing in a stock, a fund, or an asset class merely because it has had high returns in the recent past. It's like betting on a horse only because it won the last race. The allure of quick profits can be tempting. After all, who doesn't want to ride the wave of a booming stock or market trend? However, this strategy is often risky, and here's why. Firstly, past performance is not a reliable indicator of future returns. Just because a certain stock or asset has performed well in the past doesn't guarantee that it will continue to do so. Secondly, by the time you jump on the bandwagon, you may be buying at a high price, and the returns may not be as impressive as they were. Essentially, you're buying high and risking selling low, which is the exact opposite of a sound investing strategy. Finally, chasing returns often means you're not paying attention to the fundamental qualities of an investment. You're ignoring factors like the financial health of a company, its competitive position in the market, or the overall economic conditions. So what should you do instead? Well, focusing on long-term growth is a better strategy. Invest in companies or assets that have solid fundamentals and the potential for steady growth over time. Understand that the market moves in cycles, and what's hot today may not be tomorrow. Be patient and disciplined. It's better to consistently invest in a diversified portfolio that suits your risk tolerance and financial goals than to jump from one hot stock to another. Also, consider seeking advice from financial professionals. They can provide valuable insights and help you avoid common pitfalls. Remember, investing is not a sprint, but a marathon. So, don't get swayed by short-term trends and stay focused on your long-term financial goals. After all, the tortoise did win the race, didn't it? Next up, not diversifying your investment portfolio. You've probably heard the old adage, don't put all your eggs in one basket. Well, this rings especially true when it comes to investing. Diversification is an absolute must, yet many investors overlook its importance, leading to a common and costly mistake. But what exactly does diversification mean in the context of investing? In simple terms, it's the practice of spreading your investments among different types of assets and sectors. This could include a mix of stocks, bonds, real estate, and even alternative investments like cryptocurrencies or commodities. Why is diversification so crucial? Imagine you've invested all your money in a single company's stock. If that company faces a significant setback, your entire investment portfolio takes a hit. That's a risky position to be in. Diversification reduces this risk by spreading it across multiple investments. If one investment performs poorly, the others might perform well, balancing out the overall impact on your portfolio. Now, diversification isn't just about having a large number of investments. It's about having a variety of investments. For instance, having 100 different stocks in the same industry isn't truly diversified. A downturn in that industry could still lead to significant losses. True diversification involves spreading investments across different industries, regions, and asset types. The benefits of diversification are numerous. It can provide a level of protection against market volatility as well as potential losses. It also gives you the opportunity to benefit from different sectors and trends. Remember, no one can predict with certainty which investments will perform the best. Diversification helps to hedge against this uncertainty. But remember, while diversification can help mitigate risk, it doesn't eliminate it. Every investment comes with some level of risk. The key is to diversify in a way that aligns with your investment goals and risk tolerance. In conclusion, ignoring the importance of diversification is a grave mistake. It's like going into a battle with only one type of weapon. You wouldn't do that, would you? So why take a similar risk with your hard-earned money? Diversification is your best defense against market volatility. It's a simple yet powerful strategy that can help you navigate the unpredictable world of investing with more confidence and peace of mind. Neglecting research is a mistake you don't want to make. Let's delve into why that is. The world of investing is not a game of blind darts. It requires a keen eye and a sharp mind. Thorough research is your compass in this vast sea of financial opportunities. It's the difference between navigating through stormy waters with a reliable map or sailing aimlessly in the dark, hoping for the best. Now you might be wondering, what's the harm in making a quick investment based on a hot tip? Well, it's simple. Without doing your due diligence, you become vulnerable to the pitfalls of hearsay and trends. It's easy to get swept up in the current of popular opinion, but remember, the tide can swiftly change, leaving you stranded in the middle of a financial mess. Investing based on trends or hearsay is akin to building a house on sand. It may stand for a while, but when the tide comes in, it's bound to crumble. Our financial decisions should be based on solid ground, on facts and figures, not on the shifting sands of trends or gossip. So, how can you conduct effective investment research? Start by understanding the basics of the company or asset you're interested in. Look at its financial health, its performance history, and its future prospects. Is the company profitable? How does it fare against its competitors? What are its plans for growth? These are just a few of the questions you should be asking. Next, consider the broader economic and industry trends. How is the market performing? What are the forecasts for the industry? Is it growing or stagnating? This kind of macro-level analysis can help you see the bigger picture and make more strategic investment decisions. Lastly, don't forget to regularly review your investments. The financial world is dynamic, and what worked yesterday may not work tomorrow. Regular reviews can help you stay on top of changes and make necessary adjustments. Like a diligent detective, piecing together clues to solve a mystery, your research can help you uncover valuable insights that can guide your investment decisions. After all, informed decisions are always better than uninformed guesses. Lastly, but certainly not least, is investing emotionally. Imagine this. You're browsing through your favorite financial news site, and you stumble upon a headline that screams, "The next big thing in tech." Your heart races, your palms sweat, and before you know it, you've poured a chunk of your savings into this so-called next big thing. Sounds familiar? You've just fallen into the trap of emotional investing. Emotional investing is a dangerous game to play. It's the act of making investment decisions based on feelings, rather than facts, analysis, and a comprehensive evaluation of the reward and risk. It's the fear that grips you when the market takes a dive, the greed that takes hold when you see a hot stock on the rise, and the regret that gnaws at you when an investment doesn't pan out as expected. Now, these emotions are perfectly human. We all feel them. But when it comes to investing, they can be your worst enemy. They can cloud your judgment, lead you to make impulsive decisions, and ultimately put your financial future at risk. So how do you avoid falling into the emotional investing trap? Well, the first step is to recognize that emotions can and do influence your investment decisions. Awareness is half the battle. Second, develop a solid investment strategy and stick to it. A good strategy should take into account your financial goals, risk tolerance, and investment horizon. It should be your guiding light, helping you navigate through the stormy seas of the financial market. Third, stay informed. Knowledge is power. The more you know about the market, the better equipped you'll be to make rational decisions. And remember, it's okay to seek help. Financial advisors, for instance, can provide valuable insights and help keep your emotions in check. Lastly, practice patience and discipline. Rome wasn't built in a day, and neither is wealth. It's the steady, disciplined investors who often come out on top in the long run. Keep your emotions in check and let your investment strategy guide you. That wraps up our list of the biggest investing mistakes to avoid in 2024. We've journeyed through some of the most common pitfalls investors can stumble into, starting with the silent but deadly inflation. We've explored how inflation can eat into your returns and how vital it is to always consider it when planning your investments. Next, we tackled the allure of chasing returns. It's like running after a mirage in the desert, isn't it? It looks so promising from a distance, but as you get closer, the image dissolves into thin air. It's important to remember that past performance is not indicative of future results. The market is a fickle beast. It can be your best friend one day and your worst enemy the next. We also discussed the importance of diversifying your portfolio. Putting all your eggs in one basket isn't just a cliche. It's a dangerous game to play. Diversification can help you spread the risk and increase the potential for returns. Then, we underscored the significance of doing your homework before investing. Research isn't the most glamorous part of investing, but it's arguably the most critical. It can mean the difference between a successful investment and a costly mistake. Finally, we looked at the danger of letting emotions dictate your investment decisions. The stock market isn't the place for knee-jerk reactions or impulsive decisions. Patience, discipline, and a cool head are your best allies in the world of investing. Remember, the goal isn't to be perfect. Even seasoned investors make mistakes. The key is to learn from these mistakes and to continuously strive to make better, more informed decisions. So, keep these tips in mind as you navigate the investment landscape in 2024. Let them guide you towards savvy, successful investing. If you found this video helpful, remember to subscribe, like, and share. Stay savvy and happy investing.